Hello, welcome back, guys. It looks like Tesla is up quite a lot today. Now, the markets haven't opened yet, but you will see that pre-market is actually up about 10% right now. After reporting earnings, you can kind of see it here in our stock news page. Tesla shares pop over 9% on better than feared earnings results. So what key metrics I had to say, the eighth straight quarter where Tesla actually beat earnings. So let's take a little bit of a closer look at what happened, and later on we're going to talk a little bit about Tesla and discuss a few things about it. Now, Tesla shares pop over 10% on better than feared earnings results, demand outlook. You will see here that analysts offered a more mixed response overall, but investors pretty much responded enthusiastically, and this is a key thing when we're talking about companies like Tesla, which have been having a very positive sentiment over the past. And you do know that once the stock price gets suppressed, when the slightest positive thing happens, then you may see an erection pretty much. And this is what we're seeing today, it looks like. And for instance, an analyst over here maintained a buy rating with a $275 price target. But let's take a little bit of a closer look at what happened here. So Tesla cut prices. Remember that at the end of 2022 into 2023, which we did talk about in a previous video. And of course, it has to tell us a few things about the potential demand of the company. And you will see here, without some big supply chain interruptions pretty much or any other problems, they do have the potential to do about 2 million cars. That's a lot, of course, understandably. There is a lot of demand for Tesla, and that's the nice thing about the company for sure. And thus far in January, we have seen the strongest orders year to date than ever in our history, is what they are saying. Another positive signal here for potentially the company's guidance becoming better and better. Very nice to see. And you will see here in this article, which is talking about Elon Musk saying that Tesla will be selling up to 2 million vehicles this year, that Elon Musk basically wanted to appease investors and kind of told us that the most common question he's getting was about the demand of the cars, and he wanted to put the concerns to rest, as you'll see here. Now, the company obviously has been battered in 2022, lost a lot of its market cap value. As you'll see, 700 million in market cap is what they lost, about 40%. That's a lot. And this is where a lot of people are potentially flocking in to buy the stock. And this is where we're going to be taking a little bit of a closer look. But you will see that the update of Elon Musk came as the electric vehicle company reported record revenues of 24.3 billion for the December quarter, up 37% from last year, which is extremely significant, as you can understand, since analysts were expecting $24.2 billion. A net income of $3.7 billion was slightly ahead of forecasts of 3.6, so doing better than expected. And of course, expectations were lowered to begin with, because we did expect lower things of most companies, frankly, right now in this current situation in the market. And Tesla seems to have beaten that handily. Now, the gross margins shrank during the quarter to 25.9%, down nearly 5 percentage points from a year ago. Again, this is something that we kind of knew about, because we did talk about discounts in Tesla prices, and that definitely has a say on their profit, on the profit that the company is generating. But Tesla had its full year net profit in 2020, earning $721 million, and 2 years later it has earned $12.6 billion, more than $10.5 billion expected profit. And as you can understand, this is a company that is growing massively, but the important thing here is to see whether it makes sense to buy that, and we kind of need to examine what the company is doing at its financials, at its core, not just what it's doing with its operations, because we do know that the company is selling a lot. We do expect them to keep growing at a relatively nice pace in the future. But the thing is, and what we really should care about, is this a cheap price to pay right now? And we're talking about $159, it looks like, when the market opens today, maybe even more than 160 later on in the day, we'll see. But you can kind of see that the P ratio of the company and the price to free cash flow are still elevated, very elevated. And they used to be like 1,200 at some point, or 1,000. It's gone down a lot because the stock price has fallen off a cliff. Again, take a look at the 1 year chart. It's been a massacre here. Now, lately it has been going up slightly, I guess in 2013 for the most part. But overall, you will see from its 1 year high, 62% down. That's a lot. So from a 1 year ago, pretty much, That's quite of a lot, and at some point was even more than $384, close to more than 400, frankly. So yeah, the stock price has fallen off a cliff. That helps a ton. But is it still cheap enough to buy and actually invest in this company for the years to come? Because the stock price is actually here doesn't mean that it will eventually go here in like 2 years or 3 years or 4 years. It may get there in many more years. So we have to be making sure that we are buying at a cheap price because there are multiple opportunities in the market right now, and we just don't want to be overpaying, especially in this current environment. And even if you look at this company being up today at 10%, I wouldn't be too carried away from this event pretty much, and I will be just very, very cautiously examining what the company is doing here. And you will see that they are still actually issuing shares. They have been issuing shares till pretty much the end of 2022. Never really stopped, which makes sense because the company stock price was expensive and they wanted to make some money. Now, they do have quite some liabilities compared to the free cash flow that they generate, but not enough debt compared to the equity that they have. That's another good sign. But the margins of the company, you can kind of see here, they have been elevated for the most part. The company's margins have been getting better and better, apart from pretty much the most recent quarter right now, where things are going a little bit slower again for the quarter. Now, a quarter doesn't necessarily mean much, but it's important to realize that. And the growth of the company, again, pretty fantastic here. That's a nice feature of the company. The kind of growth that they have here, they are really growing fast. So this is something that you really, really like to see out of this one. And it's one of the most important features of the company. Now, in this tool, which is available to our Patreons, every Patreon has access and you can become one and get access. The link is in the description box below this video. I'm currently working on a new feature here, which I think is going to be super nice. And again, it's still on the works, but I kind of wanted to show you an initial screenshot of what it looks like for the first two scenarios. This is sort of like an events alerts feature. It's going to have many more scenarios here, but the first two are about the outstanding shares and the diluted EPS here. Now, I kind of wanted to show you a more like normal company where things are much better here. And you have to bear with me because this is actually running on my local host, so it's not as fast as the actual service is online, but it's still okay. You will see here that Apple, for instance, has a reduction in outstanding shares. So there is no dilution. They're actually buying back shares. And so this is down like 19%. That's the outstanding shares count. It used to be 19 billion, now it's 16 billion. So they're actually buying back shares. And the diluted EPS is about the same with the actual when compared to the actual EPS. Now, why does that matter? Of course, I have an issue explanation here, but I will explain it to you since I'm making this video, of course, in a probably easier way to grasp. When we're talking about an EPS, we're talking about the earnings per share, right? So how much earnings are allocated per share, per unit, per stock unit that you are owning potentially as a stockholder. When we're talking about a diluted EPS, though, we are accounting for potentially convertible shares, for example. And so this means that in the future, a company may have sold some convertible bonds, shares, and things of that sort, and pretty much increase the amount of outstanding shares. And when that happens, you are getting diluted. So you are getting some extra dilution in the upcoming years, months to come. And you kind of need to know about this one. This is very, very important. And in this case, the difference is like 0.7%. So it's very little when we're talking about Apple. But when we take it back to Tesla here, you will see a different story, a very, very different story. And it's really, really important to understand why this matters. Now, the dilution, we talked about it, is 26%, 26.5%. So a lot of dilution going on here. That's a first bad sign. The company used to have 2.4 billion in shares, that is, outstanding shares. Now they have 3.14 billion shares. So that's significantly more, 26% more. It's an increase pretty much of 26% from what they used to have. So that's significant because you get diluted as a shareholder. And another thing that dilutes you as a shareholder is the fact that the diluted EPS is actually lower than the current EPS, which means that there is some amount of outstanding shares to be sort of like allocated in the future for people who have actually pretty much bought into this kind of investments. And so this means that as you as a shareholder are getting extra diluted here because of this difference of EPS to diluted EPS. So you need to account for that as well. So these pretty much alerts here are already telling you there is a lot of dilution going on here for you. And you have to be super wary about this one and account for that when you are taking a look at our stock evaluation pretty much DCF model, which tells us how much the free cash flow that the company generates is worth to us. And over here, you can kind of have your assumptions and say that, let's just say that the Tesla keeps growing at like 10%, that's a lot, of course, 12% and 14% for the next 5 years. Obviously, that's a tremendous amount of growth. I'm not sure that Tesla will be achieving that for 5 years. But the net income margins, again, they have been elevated recently. Now, you will see that the fiscal year 2021 was 10%, but it grew from there. Like the most recent quarters, we talked about them, it was like 20, 25%. So I'm willing to go higher. I'm going to go 20, 22, and 24 here. And the free cash flow margins that I'm going to use, again, this is all over the place for Tesla. And it's understandable. Again, it's a company that has been growing and allocating funds in capital expenditures. So I will go with something that is rather typical for a company, something like 80% of the net income margin. That would be about 19% in terms of the revenue. And 90 and 100 over here, and an annual return of 13% is what I usually use. And when I hit calculate, you will see here that the low price to pay for Tesla would be something like 55, 74 for our medium, 98 for our high. The current price being at 144 points. Actually, the current price is actually more than that. It's actually 160 almost right now. Remember, this is up 10% right now. Pre-market, the market hasn't opened yet. But this is probably going to be 160. And as you can understand, this is expensive. And again, you have to account for the fact that we're getting massively diluted as well. The margins are going down potentially a little bit, so there may be some issues here for the company. It's still very, very expensive, so I can't see myself buying this one, even though I would love to get some Tesla stock at some point. It would have to be lower than 100 actually for me to be interested in buying Tesla, because right now it's expensive and it's getting more expensive. But I did want to make a video, talk about what happened with the earnings pretty much, and mention a few interesting things about how to navigate Tesla and the stock, of course. And this basically always works with pretty much every stock. So this is how you should be analyzing your stocks, and not just pretty much base your decisions on sentiment. That's not the best way of investing, pretty much not the best way to invest. But thank you for watching, and thank you for watching this video, and thank you for being around. Remember to leave a like and subscribe if you are new around here, and be around, because at some point I will let you know more about the alerts, and there will be more videos as well. But thanks again for watching. I'll see you soon. Bye-bye.